The San Francisco Bay Area housing market is leading the nation, but not in a good way. They're seeing some of the largest price declines in the nation. The big question is, are we through the worst of it, or are we going to see a repeat of the last California housing market crash? I'll be covering all that and more in today's regional market analysis. Let's get into it. The latest data from Redfin, a national real estate brokerage, shows the major metropolitan areas in the San Francisco Bay Area are experiencing some of the most dramatic price declines in the U.S. From the recent peak in April of this year, the San Francisco metro area is registering the sharpest decline, falling 11.4% through August. The Oakland area is not far behind, with a 9.3% decline over the same time period, and the San Jose metro area is down 8.5% as well. Make no mistake about it, these are some serious declines in such a short period of time, just 4 months. Two things we're going to look at next to give us more context for how to make sense of this. First, we're going to look at how these stats compare against other large metropolitan areas in the country. And second, how does the speed of this decline compare to the last housing market crash, where California metropolitan areas were affected more than many other areas throughout the country. And then finally, I'm going to look at how much prices could head lower in the next 6 to 12 months. On the first point, I've analyzed Redfin's monthly price data for metropolitan areas throughout the U.S. To make it a more meaningful comparison, I limited the analysis to larger areas with sales volumes over 500 units per month, giving me a list of 147 metropolitan areas. Of those, our 3 Bay Area metros ranked first, third, and fourth for largest price declines from April to August 2022. Okay, so we know the price declines in the Bay Area are pretty much the worst in the nation right now, but how does this compare to the previous housing market crash back in the 2000s? Unfortunately, Redfin doesn't have data publicly available that goes back that far, but I do have monthly data from the California Association of Realtors that we can use for a comparison. In their data, they combine all 9 counties in the San Francisco Bay Area, and for that broader region, the median price for a single-family home dropped only 2.7% from the seasonally adjusted peak in April 2007 to 4 months later in August 2007. In contrast, the 9-county Bay Area median price has declined 10.1% from its recent peak in April 2022 through August 2022. So we're seeing a much sharper decline now than we did in the last housing market crash. Back then, it took 9 months for prices to decline by the same magnitude we're seeing now. The sharper declines now, however, are due mostly to the shock from mortgage rates that have risen sharply, eroding affordability and crushing demand. In the last housing crash, things unraveled a bit more slowly and didn't have the sudden shock to demand that we have now. So what we've seen so far is that the San Francisco Bay Area housing market is leading the nation for the largest drop in median home prices, and it is happening faster than the last housing market crash in California. The big question now is whether this is the worst of it and prices will level out, or are we just in the beginning stages of a much larger crash like what we saw back in 2007 and 2008. To answer that, I'm going to approach this from an affordability standpoint, as I've done in my market crash update videos for the nation overall. I think this approach is more appropriate to take than a supply side approach, because it is the shock to demand that is the driver of these price declines. Supply is still near historically low levels, even if they have started to rise in recent months. For my affordability analysis, I have 3 main inputs: median prices, median household income, and mortgage rates. From these, I can calculate the average housing payment as a share of income. When I do that for the 9-county Bay Area, here's what I get. The average housing payment as a share of income hit a peak of 71.5% in May, rivaling the peak of 73.7% back in January 2006. Now, at this point, you may be saying, what? People are paying 70% of their income on housing? No, not exactly. The Bay Area and California in general has a ridiculous affordability problem, which shows up clearly in my calculation here. To give you a better idea of how ridiculous it is, here's an estimate from the California Association of Realtors on how much income it would take for a first-time homebuyer to purchase a home in the Bay Area in the second quarter of 2022. It took an income of $208,800 to buy a home at the median price of $1.27 million. My estimate of the median household income for the Bay Area was about $120,000 for the second quarter. So you can see that even people with the average income in the Bay Area are priced out of home ownership, and that is why my measure of the average housing payment as a share of average income goes up to 70% in the extreme. That being said, we're going to use my measure to take advantage of the historical trend within it to estimate how much farther home prices could fall. As I mentioned before, the average housing payment as a percent of the average income in the Bay Area reached 71.5% in the recent peak and has since come down to 64.6% due to how much home prices have fallen already. When we look at what happened in the last housing crash, this measure went all the way down to 26.9%. Why did it go so low? Well, from the peak in April 2007 to the bottom in March 2009, the median price in the Bay Area fell by a staggering 55.9%. Now that was a housing crash. Now, I don't think we're going to see a crash like that this time around, and for a few reasons. First and foremost is the quality of buyers. They're much better now than back then when you didn't have to provide any proof of income with some lenders in order to get a mortgage. Lending practices are much stricter this time around, so we're not going to see the same kind of foreclosure wave and distressed sales hitting the market inventory. And second, the cause of the declines are a bit different. Right now, we're experiencing a shock from a sudden rise in mortgage rates, preventing people from getting into a loan, while back then it was a problem with subprime loans where adjustable rates started kicking in and buyers got underwater on the loans they were already in. It was certainly more complex back then than that, but we really are in a different situation here. Let's get back to my affordability metric and see if we can't find a more realistic path for where home prices could go. In this data going back to 1997, the average share of income has been about 50%, and that seems to be about right for where we could reasonably expect it to return to. Before the last housing bubble, it was hanging out here just above 50%, and just before this recent surge in prices, it was trending just below 50%. So I think that it's a reasonable assumption to make to try to figure out how much home prices could fall. Using this, along with some conservative projections for the median household income and mortgage rates, I can calculate what would have to happen with home prices in order for that share to return to 50%. When I run the numbers, I find that if income and mortgage rates don't deviate too much from their current trends, the median price in the Bay Area would have to fall by 32.7%. for the average housing payment as a share of income to reach the historical average of 50%. Something I want to stress here is that this is not a forecast. It is a scenario that depends on some very specific assumptions. First, it assumes that incomes are going to rise by historically average rates. This could definitely change if the U.S. enters a severe recession. Some would argue that we are already in a recession as GDP has contracted for 2 consecutive quarters. But that is a topic for my other channel where I'm tracking the overall economy. I'll be providing an update on the U.S. economy on that channel in the next week or so. I'll leave a link to that channel and the most recent video on the subject in the description down below if you want to check it out. Now, if we enter a severe recession and incomes fall, home prices would likely fall more as well. Second, it assumes that mortgage rates don't go beyond 7% over the next 12 months. That was a reasonable assumption when I first started building my model for this, but mortgage rates have already hit 6.7%. If mortgage rates could go higher than 7%, we could also see home prices decline by more than we would see in my scenario. And finally, it assumes that the average housing payment as a share of income will return to the historical average. If you're interested in regular updates on the Bay Area housing market going forward, let me know in the comments section below. If there's enough interest, I can definitely make that happen. A projected 32.7% decline in home prices definitely qualifies as a crash in my opinion, and we're already a third of the way there. Depending on what happens with all of those inputs in my model, primarily income and mortgage rates, we could see different results, better or worse. Now, if you found this video useful, please give it a thumbs up to support the channel and help us grow. And if you like this type of housing market analysis, make sure to subscribe and hit that notification bell down below so you know right away when my next video on the subject comes out. Thanks for stopping by. I'll see you in the next video.